So Michael Burry is without a doubt one of the greatest investors of our generation, having successfully predicted some of the strangest outcomes in the past couple of years, such as the mortgage crash, over-leveraging on crypto, and out-of-control inflation. It's a wise move for us mortal investors to listen when this bloke is speaking. But now Burry is back saying we are heading into a consumer recession, and I quote, heading to a very cold and dark place. What is more is Michael Burry has actually put his money where his mouth is and shorted with big size one of the greatest companies ever to have existed on Wall Street. In Michael Burry's latest filing on March the 31st, it shows that he has a giant bearish 206,000 share put against Apple. Yes, that is a crazy position, and what's more, it's his biggest position that we know of in his portfolio. This crazy guy thinks the market will continue to fall, and even the giant that is Apple will fall far, far from the tree. But what stocks does a foreseer like Burry buy when even Apple is expected to fall? What stocks does Michael Burry think will continue to thrive in a cold and dark place as the stock market continues to spiral downwards? Or to put it a more simple way, what is Michael Burry's recession-proof stocks? Well, the good news is because of rules and regulations, Michael Burry actually has to declare what he's been buying every single quarter, so we can see exactly what he's bullish on when he expects the market to crash. But before we get into that, do me a favor, make sure you have helped me with that like button. It does help me out tremendously with the YouTube algorithm, and just by doing so, I'll show my appreciation later on in the video by telling you the greatest dad joke of all time. And trust me, it's not to be missed. So Michael Burry, known as the Perma Bear of Wall Street, the 2008 savior, and the Tommy Lee of the stock market. And to be real with you, I just completely made those nicknames up, but maybe one of them will stick. But Burry himself has actually been, by definition, a perma bear. He's been expecting the stock market to crash for a couple of years now, as stock prices have been spiraling out of control, and we are in a bigger hype scenario than what we experienced in the dot-com bubble. And Michael Burry has even put his neck on the line with this mega giant short position on Apple. And to be clear, yes, he put a short position using puts, limiting his risk with 206,000 puts. Meaning, if Apple falls, he's going to make a hell of a lot of money, and if Apple runs to the upside, he can only lose so much, which is an insane, confident bet for any investor. You should never really have 17% of anything in your portfolio. But other than the big short in Michael Burry's portfolio, and hopefully you see what I did there, he has been buying some stocks too. Companies that he feels will weather the storm and actually produce decent returns even in a market crash. So let's have a little dive into some of these stocks and try and figure out why he's actually buying them, because I found one very big similarity with most of the plays. Now, looking at these holdings, there's some things that jump right out at you other than the big short on Apple, which is slightly contradicting, and that is his big position he's just put on Google going long, and also on Meta, which used to be Facebook, which of course these three companies are all in the same sector, so why short the big one and then go long the little one? It doesn't really add up unless you look at this one key statistic where these companies are actually an outlier. Burry has long said that the tech sector and stocks in general are overhyped and overpriced, and the mother of all crashes is coming. So why is he going long in an overpriced tech sector on Meta and Google? If we look at just Google and Apple, I think they're the two you can really compare, because after all, Meta is changing its complete business model. You can see that a lot of the similarities lie in their ratios. I mean, if we look at just the price to sales, Google's is currently 5.7, Apple's is 5.9. Pretty much the same. The PE of Google is 20, Apple's is 22, and the price to free cash flow equity, both of them are 22. And these are the most popular valuation metrics most good investors tend to use. So by these commonly used metrics, it shows that there is hardly any difference at all. So it doesn't justify the point of shorting one and going long another, unless there is another statistic which is the big outlier. And I think I found it, and that is the price to book value. Now, the price to book value is one of the most boring metrics out there. It doesn't account for future revenue growth or care about how much this company is going to go to the moon. It just simply gets its book value, i.e. its assets minus its liabilities, and compares it to its price. In other words, investors use the price to book value to gauge whether a stock is properly valued. And if you're still not getting what a price to book value, the easiest way, and trust me, it's not this simple, way of describing a price to book is if you just closed the company and sold every everything today, how much value is it compared to the current price of the business? Now, the higher the price to book value traditionally means that the company could be overvalued, and the lower usually means that the company is somewhat undervalued. However, you should compare the price to book value with other companies within its sector, because, for instance, the tech sector usually has a much higher ratio than something like a utility. But if we just look at the tech sector and we look at companies that are quite similar, like Meta, Google, and Apple, luckily they're all in Burry's portfolio, and he's short one and long the other two. Now, Apple's price to book value is actually quite high at 34.1, but Google's price to book value is not 34, it's not in the 30s, the 20s, or even in the 10s. Its price to book value is only 6.1, and Meta, also known as Facebook, is only at 3.7. These two companies are showing if you close the business and you sold everything, their price to book value is much better than what Apple's would be. And of course, none of these companies are going to close their doors. It just means that in a recession scenario, when you come to value a business, if the shit does really hit the fan, these metrics are really going to count. I feel like Michael Burry is sort of using one of these metrics in maybe his own Michael Burry way to value a business. What is a good deal and what is a bad deal? A 34 price to book value is definitely quite high. Given the fact that Apple has fell a lot recently already this year, I think that Michael Burry is buying companies like Meta and Facebook rather than Apple because he feels these companies are already close to a good buying value opportunity. I don't think he's buying them because of revenues or the future projects this company has to offer. It's more on the point that the whole market he's expecting to crash, and these companies are already close enough to their resale value where it warrants an undervaluation. Apple's one of the most held companies in portfolios, so as people want to lock in gains, it's going to put a lot of pressure onto Apple. So why not hedge your bets and bet on the way down? That way, if the market does fall, he wins on Apple, in which case makes money. And if the market does indeed rally, luckily, he's got limited exposure to the upside because it's a put option on Apple. And at the same time, his Meta and Google stocks will push his portfolio upwards. He can't really lose that much. So in a way, he's trying to win both ways, whichever way the market goes. And in one case, he could actually win twice, where the market would indeed fall and then he'd cover his short and then use that funds to buy back Facebook, Google, whoever at a much lower price. But given all his speculative tweets about the bubble and how we're heading into a big recession and crazy inflation rates and the doomsday is literally going to happen any day now, nobody thought Michael Burry would buy tech. I don't think anybody expected this on his last filings. But on these filings, it actually showed he wasn't just buying tech or shorting Apple, he was buying other companies too. And guess what? My price to book value thesis plays out on all but one of his plays. Bristol Myers Squibb, whose company name I can never pronounce correctly, is currently coming in at a 5.3 price to book value. Discovery, Warner Brothers, price to book value is a 1.1, Cigna Corp is a 1.8, OVV is a 2.5, Nexstar is a 2.3, Stellantis, and whenever I see this ticker, I always confuse it with Tesla, STLA, TLSA, very confusing, but STLA pays you currently an 8% dividend and has a 0.8 price to book value, extremely low. You then have Global Payments, ticker symbol GPN, at a 1.3 price to book value, Sportsman's Warehouse coming in at 1.5. In fact, the only company with a sort of outlandish price to book value is Booking.com, and I can't understand why. I really don't get this one, and if anybody's got a thesis on why he's bought this, maybe he's expecting the world to reopen properly and travel and Booking.com will rebalance itself. Maybe that's the case. It's a more speculative play. I really can't understand this one because I don't like it. Let's just say that. But it's clear from everything else he owns, he's looking at the price to book value as being one of the core metrics from when he's rebalancing his portfolio. Last year, in the third quarter, we seen him sell everything, and now he's started buying back companies he feels are good undervalued plays. The big question for Michael Burry is, what does he buy next? His next filings are gonna come out in the next couple of weeks, and we will see if he's been buying more of these companies, adding more puts onto Apple, and it's gonna be very, very interesting if my price to book ratio thesis still continues to play true, because I honestly feel it will continue. And these are the stocks Michael Burry thinks will do well in a recession. But I did promise you a dad joke, and I'm going to tell you what that is after this urgent breaking news announcement. You heard it here first, maybe, that if you want to use eToro now in the States, stock trading is available in 46 states, and the rest should soon open too. If you sign up with eToro via the link for the US people down on the pinned comment, not only do you get a lifetime pass to our glorious chat room, you also get $10 when you simply deposit 100. The easiest 10% return you're gonna get this year. And if you're not from the States and you still want chat room access, there's also a link for you down there too. So if you're interested in that, go and check it out. So now for the dad joke you've all been waiting to hear. What happens to a frog when his car doesn't start? Well, of course, he needs a jump.
What?
No? Bad? Okay then. Well, if it still doesn't start, then he needs to get towed. Whoa! I'm sorry. I love these dad jokes. I actually used to say it a lot in my old job, and I've never used to say this before, but if you didn't know, I used to actually work in a shoe recycling factory, and I had to leave it because, well, it was soul destroying. Come on now. Honestly, hope you enjoyed it. Let me know your thoughts on what stocks you think Michael Burry will buy next down in the comments. The code word is Michael. And if you want to see how Warren Buffett picks his stocks, check this video out up here for the 3 key criteria Uncle Warren uses when he buys any business. Take care. Good luck out there. Peace.